Greetings of the day. Today I will be presenting on credit rating in context to finance a startup. Let's begin by defining credit rating. A credit rating is evaluation of company's creditworthiness or its financial instruments reflecting its ability to meet financial obligation. Credit agencies assess a startup creditworthiness by evaluating factors like financial health, business operations, and market positions. Based on their assessment, they assign a rating that indicates the level of credit risk associated with lending or investing in the startup. Next, let's look at the common credit rating scales used by agencies. Triple A represents prime credit with minimal risk. Double A or single A indicates high quality with low risk. Triple B reflects good quality with moderate risk. Double B or single B denotes speculative credit carrying high risk. Triple C or double C or single C are poor quality with high risk. Finally, D represents default, indicating failure to meet the financial obligation. In this slide, we will cover the first three importance of credit rating, which includes investors' confidence, access to capital, and cost of capital. Investors' confidence. Credit rating helps building trust amongst investors by including the startup's financial stability. A higher rating signals lower credit risk, making the startup more attractive to banks, lenders, and venture capitalists. Second, access to capital. Startups with favorable credit rating have easier access to funding through loan, bonds, or equity investments. Investors and financial institutes prefer startups with higher rating due to their lower likelihood of default. Third point is cost of capital. A higher credit rating reduces the borrowing cost by allowing the startup to secure loans at lower rate of interest. Conversely, a lower rating increases borrowing cost as lenders demand higher returns to offset their added or additional risk. Fourth point is transparency and market perception. Credit rating provides market transparency by offering an independent evaluation of startup financial strength. This allows investors, lenders, and stakeholders to make an informed decision based on reliable third party assessment. Coming upon to the fifth point, that is continual monitoring. Credit rating agencies regularly update their ratings to reflect the change in the startup's financial position. This ongoing monitoring ensures that stakeholders have access to current and accurate credit risk information. Let's begin by exploring the first four steps involving the process of obtaining credit rating for a startup. The first one is research and selection. Start by researching a reputable credit rating agency in your region. Consider their credibility, track record, and expertise in assessing the startups before making your selection decision. Coming upon to the second point, contact the credit rating agency. Reach out to the chosen agency through website, email, or phone. Express your interest in obtaining credit rating for your startup. The third point is provide information. Start by sharing your details about your business, which includes financial statement, business plans, and market projections. The fourth point is engagement and due diligence. The agency will conduct a thorough evaluation of your startup financial health and industry outlook. They may also request clarification or additional details during this phase. The fifth point is credit rating assessment. Based on their analysis, the agency will assign a credit rating reflecting your startup's financial strength. The rating may include outlook like positive, stable, or negative, indicating your future expectations. The sixth point is credit rating report. You will receive a detailed report explaining the rationale behind the assigned rating. The report outlines factors like strength, weakness, potential risk. Coming upon to the seventh point, review and dissemination. Carefully review the report and request for clarification if you spot any error. You can then share the rating with the potential lenders, investors, or regulatory bodies as needed. Now, let's explore some of the major credit rating agencies operated in India and globally. In India, the key agencies include CRISIL, CARE, which are widely recognized for their financial assessment and reliable credit evaluation. Additionally, we have Brickwork Rating is known for its focus on small and medium enterprise, including startups. On global scale, two most prominent agencies are Moody's Investor Service and S&P Global Rating. Both are renowned in their depth of financial analysis and influence on investors' decision worldwide. Now, coming upon how credit rating impact the startup finance. A positive rating offers several advantages like easier access to capital and lower interest rates on loan. On the other hand, the negative rating comes with a challenge like higher borrowing cost and increased scrutiny from investors, making it harder to raise funds. Now let's explore the challenges the startup faces when trying to obtain a credit rating. One of the primary challenges is limited financial history, as many startups lack credit records, making it difficult for agencies to assign a high credit rating. Another challenge is high dependency on founders' credit, especially when startups are early age, where personal credit worthiness of a founder may influence the overall rating. Lastly, the cost and time involved in obtaining a rating can be burdensome, as the process is often expensive and time consuming, adding further strains on startup. Let's review some real life examples showcasing the impact of credit ratings on startup. In India, Byju's benefited from positive early ratings, which helped the company to attract large scale investments from major venture capitalists. Similarly, Zomato experienced a surge in investors' trust during its IPO as a stable credit rating boosted share price. On global scale, Tesla saw a significant advantage when it improved credit rating and lowered its cost of borrowing and enhanced its overall market valuation. To conclude, here are the key takeaways from the presentation. Credit ratings significantly influence the startup finance by impacting borrowing cost, credibility, and investors' trust. Startups with higher rating are more likely to attract investors and benefit from lower funding cost, giving them a competitive edge. Additionally, a regular monitoring and transparency are essential for maintaining stable credit rating. This ensures that startup can demonstrate financial reliability and sustain long-term growth and financial health. Overall, a strong credit rating is valuable asset for a startup, helping them secure capital, reduce borrowing expense and enhance their market reputation. Thank you for your time and attention.